Hi, this is Smitty with the HomeSmiths Team at Keller Williams Realty. I want to thank you for stopping by to check out our video blog. It's where I get to update you with the real estate trends here in Denver and just answer any of your questions. Today we're going to talk about how to avoid the capital gains tax when you're selling a home. All right. Before we get into our topic today, I'm going to point you to two special links. One is a home evaluation link and one is a home search tool. Okay, great places to start. All right, so the big question is, how do I avoid capital gains tax? Well, typically if it's your primary residence, this won't even be an issue, and maybe that's another topic for another day. But if you have a rental property, an investment property, maybe it's a piece of land, it's a condo you own, maybe it's a ski resort property. If you have a property that you're holding for investment, you can avoid paying capital gains and use all of that equity to trade into another property and not pay any capital gains, or at least defer those gains for down the road. Okay, so I'm going to walk you through 6 real important points, and it's really the rules to know if you're looking at doing what we call a exchange, a 1031 exchange. Okay, so it may not apply to everyone, but if you're an investor, here's a brush up. You can brush up on these simple 6 rules. Okay, let's go. First of all, both the old property and the new property must be held for investment. Okay, so you can trade from land into a condo. You could trade a condo into a fourplex. You could, do any kind of trade, real estate for real estate, as long as what they term like kind. It's held for investment. Okay, 2, there's a 45-day identification period. From the sale of the old property, you've got 45 days to identify, pick out the new home, the new investment property that you're going to eventually purchase. Then there's another time period, 180 days or 6 months from the sale of the relinquished property. Okay, the property that you're selling. You've got 6 months to close on the new one. All right, so keep that in mind. Very important. Otherwise, you mess up the exchange. You have to have what we call a QI, a qualified intermediary, hold the proceeds of the sale. Okay, they hold it in an escrow account, and we've got some great recommendations of some qualified intermediaries if you need, and they can help you out answer additional questions. But they're the ones that hold the money to trade into the new property. Okay, that's the key here. You're not actually taking possession of any of those funds, and they get reinvested into that new home. Okay, so a QI, a qualified intermediary. Now there are title requirements. You have to hold title in both homes, both properties, and I should say homes or commercial buildings, whatever it may be. You have to hold title in the same name. So if they were bought in a company name, or individual name, okay? And then the last thing, number 6, is you have to reinvest all of the cash proceeds from the sale into the new property, and you have to purchase at or greater value. Okay, but this is a super tool to use. It allows you to use all the equity and be able to have more leverage to buy a bigger home or a different property. Maybe you're moving states and want to take your investment properties with you. Well, this is a way to do it, or a way to trade up and use all of that newfound equity into purchasing another property, a larger property, something that brings in more cash flow for you. So again, if you're looking to buy a home, sell a home, or invest in real estate, we are here with expert advice and guaranteed results. As always, we appreciate you very much, and thanks for stopping by.